You say, John, actually, that the recent pullbacks we've seen, right, and it was kind of getting ugly last week.
Scary.
Then, yeah, scary is a good word. That none of that indicates to you that we're at the start of a bear market.
That's not how bear markets start historically. Bear markets, to really be bear markets, have to go down a lot. And to go down a lot, you have to start with deeply embedded optimism and end with deeply embedded pessimism. You sort of need that ambit, that swing. And if you have deeply embedded optimism, you don't have markets that go down like they did last week. So
right.
I may be reasoning backwards here.
No, okay, so you need deeply embedded optimism.
Optimism at the top.
At the top.
And
okay, what does that mean? Spell out deeply embedded optimism.
Well, I'll give you a great statistic. In the last 5 bear markets, going back to the 60s extended bear markets, they went down on average close to 50%, but you could have sold on average within 5% of the high 22 weeks after the peak. So that's 4.5 months. So it takes a while to sort of grind it away. It's not something that just pops and goes down and never comes back again. That's extremely unusual. It happened in '87. But that's fluke. That was straight up and straight down. That was a pinnacle. But usually bear markets take a while to develop. And I'd actually think that what we saw in the last few months, going back for the last couple of years actually, these nasty, brutish, and short corrections, shallow corrections, are very typical, what we used to call bull market corrections. It means we're still scared. And all it takes is a couple points down to get us a couple more points down, because after all, I said I was bullish, but I really didn't mean it. It really wasn't there. Now that I see it, I'm scared to death. I think it's a good thing.
What would make you change your mind and think this is the real deal?
Well, ideally, if I found out it was wrong quickly enough. But I think you need a period if it goes sideways for a long while. I think this has been driven by the Federal Reserve and, to a degree, what earnings have been doing. If I see signs that the declines we've seen in earnings are anything more than just a cyclical torp because of what happened with energy and what happened with the dollar, if I see the Fed about to tighten, and that's not raising rates, that's really tightening, it's trying to slow the economy down. Until I see the Fed about to do that, I'm going to stay positive. Now, does the economy just fall off the face of the earth? I've never seen the American consumer just pack up his or her kit and go home. You have to do something.
Yeah.
So, I mean, Bloomberg analysts have earnings down 5.8% first quarter, 4.2% estimate falling in the second quarter, another 1% in the third quarter. Where is the lack of concern? At what point do those levels, where's that bottom that earnings will fall to the point where you do kind of feel that visceral reaction?
Well, keep in mind also that's a pretty low hurdle to get over. If I'm expecting things to be bad and they're only kind of mediocre, that's actually a positive surprise. So, number one, you do have low expectations already. And then the other thing is earnings aren't that important. And that's because it's where we look. Sometimes the street looks at what's going on right now for earnings. But sometimes it looks out 3, 6, 9, 12 months. And usually if this is about as bad as it's going to get, and I suspect the first and maybe the second quarter are about as bad as it's going to get, the street has a tendency to sort of look beyond that. The dollar's gone up. Well, that helps Europe. Europe gets stronger. That helps the euro. Oil is down an awful lot. Well, you get all the problems in the first 6 months and most of the benefits in the second 6 months. So if this is the worst, and I suspect it's close to it, the street can sort of swing its focus out a few months, a few quarters, and that's very difficult to try and predict when it happens.
Now, John, you have, 3 investment themes, right? So one is, you say, buy integrated oil.
Right.
Is that right? So buy big oil. 2 is buy biotechs. You buy
on weakness.
On weakness, right? So undervalued biotechs.
Well, there's no such thing. I mean, you're not buying biotech because they're cheap. It's
true. They're all overvalued.
I bought the cheapest Mercedes I could find. You don't do it that way. They're very highly valued, and I'd like to see the puff come out of it, but I can't think of any time where pure valuation corrections didn't end well. In other words, if the growth is still there, if the products are still there, and you had a great segment on that a few minutes ago, if they can do what they think they can do, then I'll pay more for it down the road. And the way I look, it's like falling on an up escalator.
Yeah.
You're not going to tumble. It sort of rises up to meet you and cushion the blow. So I want to see weakness. I think what I'm saying with that is I think the fundamentals are sound. I think the timing, I think you made a very good point, the timing in terms of the research that was done 10, 15, 20 years ago, the timing is ideal. And we're starting to see the results in terms of new products. I think that sort of valuation puff goes away at some point in time, and the fundamentals are still underneath you. So that's why I do that.
And then just the third one is what, Europe? Buy Europe?
I think Europe's a good story.